And that should be us being live. Let me check. I always have to check the YouTube stream and all that just because I don't trust software.
I know
Uh,
LinkedIn, it's been coming out good too on LinkedIn so
Good.
far.
Yeah. All right. Let's see if this is. There's always a delay, so I got to make sure it's actually working. Let's reload. And not coming up on YouTube. Interesting. Let's try. Let's try Facebook, or not Facebook. We don't have enough followers on Facebook or whatever. Okay, there it goes on YouTube. All right. We are actually working, which is good. Okay. So it is Tuesday, 6 p.m., 6:01 now, and it is time for Sherpa Live, our office hours, Q&A. So, Serena, I haven't told you this yet, but we are actually going to be having a thing being launched here in the next couple of weeks where people will be able to submit their questions ahead of time to Q&A rather than just, from pulling from our client emails and stuff. Uh, so that'll be coming, but be good for people to know.
Yeah, I think that's awesome.
Yeah, it should be good. All right, so who are we? We're Tax Sherpa. We do taxes, tax strategy, tax planning. We file taxes. We'll do your bookkeeping, all that jazz. But the main thing is our goal is to save you giant amounts of money. And the reason for that is because that's where I came from. So, back in 2007, I started getting nasty letters from the IRS saying that I owed them $1.3 million. I actually found one of my transcript reports that has I got this from 2009, so this piece of paper is 15 years old, and it says number of documents on file. This was for tax year 2004. Documents on file is 863. So they had 863 transcript entries for me in 2004, and then also there was a bunch of 2003, 2005, but 2004 was the biggest one. So that was what caused that issue. But since then, cleaned up my own mess and got into the Wall Street tax planning world. And since then, I've done over 50,000 tax returns and a couple of $1 billion worth of client earnings and saving millions of dollars a year in taxes. So in 2019, I founded Tax Sherpa to make it our mission to help my tribe, which is the solopreneurs, the small business people, the independent contractors, the 1099 people, uh, all those people who can't get a job. The goal is to get your quality of life back by saving on taxes. And what do I mean by that? Well, I talk about this quote every week. The quality of our questions determines the quality of our lives. And my question is, what is the root problem with overpaying on taxes? Because you can. There's no law that says you have to minimize your taxes. There is a law that says you have to pay at least the minimum based on your situation. But there was a famous Supreme Court case way back when that ruled that people are not required to arrange their affairs in such a way as to maximize their tax burden. So, but you can't. There's no rule against it. So what's the problem with that? And the problem with it is wasting of your life, and that's what really offends me. And the older and older I get, the more important time becomes. So if you go to work, you go do your thing, you come home, you made a certain amount of money, and then you take that chunk of money and you hand it over to the government in taxes. Who are you actually working for that day? And it's not you, that's for sure. So, if we can take you from a 35% tax rate down to 15% tax rate, that's 20% savings. And that's 74 days out of the year. That's each and every year. 74 days, 2.5 months that you are giving away to the government. And people sometimes push back on me on that 35% number, but I'm talking about all taxes. I'm talking about income taxes, capital gains taxes, self-employment taxes, payroll taxes, the additional Medicare taxes. All those things get rolled in when I'm talking about that 35% rate, because the average income tax rate is about 22%. I think it's like 21 point something. But that's only income taxes. That doesn't factor in the other things. So um, the real average is about 35% when you factor in all the taxes, including state, and that doesn't even include sales taxes. It doesn't include property taxes, things like that. But for the income chunk of taxes, 35% is actually a pretty good average. So let's get back 74 days each year so that you can work for yourself instead of for the government. So that's who we are. That's what we do. So I have the answer to all tax questions. All tax all tax questions you may have, past, present, or future. The answer is it depends.
It depends.
It depends. It depends on the facts and circumstances. So what do I mean by facts and circumstances? I mean what is true for you is not necessarily true for somebody else, just because your situation, your facts are different than other people's. So my go-to example with this is $100 shows up in your bank account. And the question is, how much tax is owed on that? The answer is, it depends. Depends on what it is. Is it a gift? Is it a loan? Is it income? Is it a reimbursement? This is going to play havoc this upcoming year with the new 1099K reporting rules. So everybody who uses Venmo or PayPal or Stripe or Zelle or Airbnb even, or any of those payment platforms, they have new rules that it's actually supposed to have been started 2 years ago, but they kept delaying it. So this time they say they're serious, and we'll see if that actually happens. But as of now, they are saying that they're going to start enforcing this rule for the 2024 tax year, and that means that if you received a total of $600 or more through one of these platforms throughout the year, from it could be from one person, it could be from 1,000 people, doesn't matter. Um, if the total added up to more than $600, you're getting a four, and it's a 1099K. And a 1099K is just a report from a third-party payment platform saying, "Hey, this much money passed through our system going towards this taxpayer." And you know, the problem with that is that for these on the lower end of things, a lot of that is not income. But there's a form that you're going to have to match up with the IRS. So we have yet to see how the IRS wants us to handle this. The rumors currently are it's going to be a Schedule 1 adjustment entry, but we don't know. So like if you go out to dinner and you pay the bill and your friends send you a Venmo for the that reminds me, I got to pay my lawn guy because he takes Venmo. They were here today. Um, so if you go to dinner and all your friends pay you back through Venmo, and that total adds up to more than $600 over the course of the whole year, then you gotta reconcile that on your taxes, even though it's not income because it's reimbursement. So it's going to be a nightmare basically. And how those things get treated is going to depend on the facts and circumstances. Sometimes it is income, like when I pay my lawn guy, that is income for him, and he's going to have to report that as such. Uh, so that's a longer way of saying it depends. So all the questions that Serena's gathered, over the past little while from clients and things, I can tell you the answer to all of them is it depends. But what we try to do here on the Q&A is I'll try to tell you what it depends on, and then we can kind of get into it from there. So without further ado, Serena, what do we have going on this week?
So we have top question of the day. What strategies can be used to minimize taxes on investment income?
Investment income. Okay. So investment income can have multiple forms. So if you are trading stocks, for example, that's a lot of times what people think of when they think of investment income. You'll have a capital gain event. It could be short term, could be long term. Long term is cheaper than short term. So that's thing number one. If you can hold something for more than a year, you're automatically going to get lower tax rates. There's a caveat with that when you factor in inflation, uh, which I mean, maybe we'll circle back to. However, so long-term capital gains are going to be depends, but broad average, let's say half of the short-term capital gains, because short-term is taxed at the same rate as your regular income, your ordinary income. So that's thing number one. Strategy for dealing with stock sales is tax loss harvesting. That's probably the most common one, where if you sold something and made a bunch of money, and then you have a couple losers that are sticking around in your portfolio, then you can sell those losers and use that loss to offset the gain. That's pretty common. Usually, people will do that towards the end of the year, as they know what their capital gain is going to be. Um, so that's the common thing that people think of when they think of investment taxes or taxes on investment income. Other types of investment income could be dividends and it could be interest. So interest, I mean, there are some tax advantage interest products, and then dividends. There's qualified and unqualified, depending on if you've held the thing issuing a dividend for a while or not. And a qualified dividend, it has the same kind of tax preference as a long-term capital gain, same rate structure. So those are all fairly common. If the numbers are large enough in those things, then you can get into what I call the exotics, where you can have there are special investment vehicles that are created that generate losses. So that can be used, but you have to be in the several hundreds of thousands of dollars before that starts to make sense. And then the other thing that people don't think of when you hear about investment income is, you know, investment income through closely held businesses. So your partnerships, your S corps, things like that, where you're getting a K1 and it has some kind of income. So a lot of real estate syndications are set up that way. In the case of real estate, if you are active in some form or fashion, there's like 7 different tests to determine whether you're active or not. If you are active, then you can apply cost segregation against that investment income and then defray the cash flow with depreciation, and that will help. And if you're active, then it qualifies for counting it against your other ordinary income, so that helps. But there's all the other corporate level tax strategies that apply for uh, at that point, and then we get into all sorts of different things. There's tax credits, there's structuring concerns, there's the common strategies that we apply to a lot of businesses. We have our summit strategy sessions. We have accountable plans. We have salary optimizations. All those things to generate qualified business income deductions. So a lot goes into it when you get to that level. So it depends. It depends on what you mean by when you say investment income, because at each different stage there's different types of things that are going to apply. And then there's a whole structuring question as to, well, if I'm going to be investing, let's say I'm just buying stock, or I'm buying, let's just say stock. Do I want to do that in my personal name, or do I want to do that in a corporate entity? Because at a corporate entity, I have more flexibility. So all kinds of stuff like that will go into it. And then if you're selling things like real estate, then there's 1031 exchanges, there's deferred sales trusts. So there's many ways to skin a cat. But
Right. So I have a question, Neil.
yeah.
So how does rental income affect one's tax situation?
So rental income is going to be, well, if we're talking about just a regular like residential house, or
Mhm.
so yeah, let's just go with that. I hold on, I got a kid here. uh, so if we're talking about just a residential rental property, then the basic thing is that you're going to have your income, and then you're going to have your cash expenses, except for the mortgage, because the mortgage gets special treatment. But
Mhm.
all the other stuff, your utilities, your property taxes, your insurance, your advertising costs, commissions, all that stuff. That's all, cash expenses that get deducted against the rental income. For the mortgage part, people can get confused by this all the time. The only deductible part of the mortgage payment is the interest portion. The principal portion is not deductible, because when you pay back a loan, it's not a deduction. It's not an expense. I mean, it's a cash expense, but it's not a tax expense. Just like when you receive the loan, it's not income, right? So you can't get one without the other. So the thing is, early on in a mortgage, your your payment is mostly interest, and whether you escrow taxes and insurance is a separate issue. Taxes and insurance are deductible either way, but principal and interest, the PI of the PITI, are only the interest is deductible. So, like I said, early on in the mortgage life, then that's most of the payment anyway, so it's pretty close. But as the mortgage ages, through the amortization, assuming you're using an amortizing loan, then the principal portion grows and the interest portion decreases. So that's something to be aware of when you're calculating your taxable income from the investment property. And then we have depreciation. So depreciation is a non-cash tax expense that you get due to the wear and tear on property. And it depends on what type of property it is as far as how much you get to take each year. Because there's different rules for different categories of assets. So like a residential rental building is 27 and a half years, roughly 4% a year. So if you buy a house for $100,000, roughly $4,000 a year extra deduction from the wear and tear on the property. And there's a lot that goes into depreciation as far as if you want to maximize it or not, whether that's appropriate for your case or not, and so on and so on. So there's a technique called cost segregation, where you go in and you analyze the property and you segregate all the different assets that exist within the property into their different categories. Because there's land, which is not deductible at all. There's site improvements, which are 15-year property. There's other types of property the within the property, like furniture and fixtures is 5 years. Appliances are going to be 5 years, but like wiring and stuff probably going to be 7 years. And then there's special rules for those things that are less than 27 and a half years. Special rules as far as how much deduction you get in the first year. And then you got to look at, well, okay, with that said, is that deduction actually useful to me? And many people jump the gun on cost segregation, not realizing that they can't actually use the deduction because rental real estate, by its nature, by default, is passive, meaning that you have if your total income is under $100,000, then your passive loss, usually created by that depreciation, is limited to $25,000. As you make above $100,000 and get to $150,000, that loss limit shrinks down to zero. If you're above $150,000, your passive loss limit is zero. So if you make, I've seen cases recently of somebody making like 300 grand on a W-2, and then they had this real estate property that's generating a $20,000 loss. Like, well, that's nice, but it doesn't do anything for you on your taxes because it's passive losses against active income, and your income is too high to take any passive losses. So it just nets out to be a zero. But if you're on the lower income side, then you can use that loss. And then the 14th, it depends, is that if you can be active with that real estate, then those rules go out the window, right? So there's different active tests. The one people might have heard about is real estate professional status. And that's where you spend at least 750 hours a year on real estate related activities and at least 50% of your income generating time on real estate activities. So the real estate professional status test is a little bit interesting and different than the other ones because it applies to multiple types of activity. So like if you're a real estate agent and you're working as a 1099 contractor or a broker and you have your own business, or you're working in construction, things like that, then those can all count towards real estate professional status, whereas they don't count towards other real estate active tests. So that's one distinction with that particular test. But it's the highest level of hours and involvement. And then the three other tests that we often use are that if it's a short-term rental property where the average stay is under 7 days, then you're not in the passive rental business anymore. You're in the hospitality business. And the IRS considers that active, or Congress considers that active by default. So that's one way to get active is to use short-term rentals. A second way to get active is to spend at least 100 hours on a property, and you are the single individual who spends the most time. So that one's actually pretty hard to meet because if you have any like landscapers or handing person or real estate managers or anything like that, anybody spending more time than you, even if you're spending over 100, then you're going to fail that test. So that one's pretty difficult. And then the next test is to spend 500 hours on properties, and you don't have to be the single most involved person. So that part of the test drops off. And then if you have multiple properties, there is an election to treat all real estate activities as a single entity for these qualification purposes. So those are the tests. And then there's a secondary provision where if you met one of these tests in previous years, and you have to meet it a certain number of times within the past, I think it's 5 or 10 years, um, then you can still count as active this year, which is something that people overlook a lot. So yeah, so if you can finagle your way into active participation one way or another, then all those all those real estate deduction questions become relevant no matter what your income is. So passive, lots of limits. You got to be very careful about what you're doing as far as whether it's going to help you or not. Active, sky's the limit. You can go to town on all your loss creation strategies. And then and then not to get too deep into the weeds, but that will also affect your QBI deductions, qualified business income deductions. So something to keep in mind.
That's a whole other set of questions, right?
Yeah.
So I get a question a lot, this question a lot, Neil, which is I don't have a license to be a real estate agent, or I
Mhm.
don't, have that. So how do I qualify? I can't get that because of that. I'm like, those are two different things, right? You
Those
don't
are
have
two
to have a
different
license.
things.
Okay.
Yeah. So in I believe it's every state that at least that I'm aware of, you need a real estate license in order to sell other people's property. You do not need a real estate license to be involved with your own property. So if you have a portfolio of rental properties, or maybe one big property, or whatever it is, you can do whatever you need to for that property. You can do work on it, you can manage it, you can buy it, you can sell it, all that because it's your property. So uh, so yeah, two totally different things. Um, and if you want to go into the business of selling other people's real estate, then yeah, then you need a license.
Well, that was a quick answer on
Yeah,
that.
sometimes they're quick.
No worries, no worries. Next question, Neil. So what are the tax implications of selling a property?
So a lot. So we were just talking about depreciation. There is a thing called depreciation recapture. Basically, you have to establish your tax basis when you sell a property because it's going to be capital gain. It's a capital asset. It's used for more than 1 year, and so it's a capital gain event. And then most of the time it's going to be short. Most of the time it's going to be long-term capital gain because you're doing it, holding it for more than a year. And so you calculate your tax basis by having whatever your sale price is minus the closing costs minus uh, however much your current basis is, and that's going to be your uh, taxable gain. So now your current basis is determined by how much you paid for it originally minus the amount of depreciation you've taken. So let's say you bought a house for 300,000. Over the years, you depreciated it down to 200,000, and then you sell it for 700. Okay, and we're gonna ignore closing costs for the minute. So 700,000 sale price minus 200,000, which is now your tax basis currently, gives you a $500,000 gain. Now, what happens to the 100,000 and that you already took? Well, that's a tax break you got before, and you've got to recapture that, and that's goes under depreciation recapture is what it's called, and you're going to pay a tax on that as well, depending on the numbers involved. Depends on how much you make, depends on how much it is, depends on all this stuff. But it can be up to 25%, and it depends on what you actually sold. So if you did a cost segregation and you had some appliances or whatever, those appliances are no longer there, you didn't sell the appliances because those are gone. Those were disposed of whenever in the past. And so you have to be real careful about what it is that you're actually selling and calculate your relevant numbers then. So so yeah, the it gets complicated basically. but yeah, I think I said that wrong originally. It's going to be 700 minus 300 plus the recapture on the 100. That's the right way. Okay, so yeah, so it's going to be 400,000 gain plus recapture on 100, and that gives you the 500. Does that make sense?
Yeah, makes sense.
Okay.
We have a question about business taxes.
Uh-huh.
All right. So, what are the different types of business structures?
Sorry, did I interrupt you?
Mhm.
One other thing to factor in with real estate sales: if you had prior losses that you couldn't take, they count when you sell them. So, if you built up whatever $50,000 worth of losses that you were never able to take because they were passive and you made too much money, you take the 50 on the sale, and that decreases your gain. All right, back to business tax question.
Right. So, what type of structures does Tax Sharpa love to implement with clients, or does that just depends is on a personal basis?
Yeah, I mean it depends a lot. Um, I would say most of the time, most people should have their own company, even
Okay.
if they're a W-2 employee, because I talk to people all the time. And when I dig, I find out they're doing something. Very, very few people just go to work, go home, and do nothing. I've heard all kinds of things when I prodded people. One woman, she would go around to people's houses in the neighborhood and teach them how to cook. Another, I've had quite a number in the animal husbandry area. So I've had people raise snakes. I've had people raise beetles. And these are like all in their spare bedroom kind of stuff. I've had a couple people when I was in South Florida. There was a pretty thriving small market of raising coral for aquariums. They would have these setups in their garages where they would breed coral, and then when it got big enough, they would split it, and then they would sell off some.
Wow.
It's interesting stuff. So all kinds of animal related stuff, or livestock, or whatever you want to call it. I don't know. Uh, uh, people try to sell stuff online. People are making money from YouTube. People are doing, all kinds of stuff. And I would say at least 8 out of 10 people are doing something on the side. And what they should do is well, one, they're obligated to report it because that's the law. And two, let's take advantage of that and, implement it in a corporate structure so that we can maximize tax deductions out of it. Because once you're a corporate entity, then you have a lot of flexibility that you don't have as an individual. So, uh, so I would say the vast majority of people should have a company of some kind. And then how we treat that company is going to depend. Most of the time, S corp is going to be the way to go. Sometimes partnership, and very rarely a C corp. C corps make more sense if you're making way more, and or if you are planning an acquisition event or going public. Which again, that's the things that make the headlines in the business media, but that's not real life for most people. Like 99% of of businesses are very small businesses and are not on that path. I talked about this in an email recently where I was talking about the infinite game versus the finite game. So, a finite game is people who are playing the acquisition game where I want to build this company, I want to grow it, and then I want to sell it, and then that's it, and then I cash out with $5 million and peace out to the Bahamas or whatever. The infinite game is there is no end. It's just the point of the game is to keep playing. So pretty much all businesses fall into this category. So if you're a plumber, if you're my lawn guy who was here earlier, he's not planning on making millions of dollars off that by selling an asset. He's planning on providing services and making money and continuing to do that. Right? That's an infinite game instead of a finite game. So you know so with that said, most of the time, as far as current operations go, the lowest tax way to have an income or to have income flowing through your ecosystem is through an S corp. So it's about I've done the numbers on it, and 92% of the time, S corp is the right way to go. Now that doesn't mean that's the only entity in your world, and it doesn't mean that's the only type of entity in your world. You might have C corps, you might have partnerships doing other things, providing different kinds of structural benefits. But as far as the main line of income, usually it's going to be an S corp. And the reason for that is, well, there's many reasons for that. So one is it's lower audit risk. Two is that unlike a partnership, S corp profits do not carry self-employment tax consequences. And uh, you know, and the third thing is that it creates qualified business income deductions. And the fourth thing is that about uh, up to about $500,000, depends on your filing status, but up to about $500,000, the average graduated rate that you pay is going to be lower through an S corp than it will be through a C corp plus a dividend. Above the 500,000, they're about equal, um, but it just depends on the numbers. So yeah, that's all reasons to have an S corp. But there are certain strategies you can't do with an S corp. So then we start to roll in other things. So that's a long way of saying it depends.
Right, right. So let me ask you a question. What is the percentage rate of audit risk on a 1040 versus the S corp?
That's about a fact. Well, the audit risk rate of a 1040 with a Schedule C business versus
Mhm.
an 1120S is about a factor of 10.
Okay.
Yeah. So it's a significant difference.
All righty. So, Neil, is there a way that when a client has a S corp, right?
Uh-huh.
If they want to add like retirement, can they do that with their S corp if they're a employee and employer
Yeah.
of the
So
company?
the thing about retirement plans is that they are a function of earned income.
Okay.
So S corp profits are not earned income because you're not paying self-employment tax on them. A W two from an S corp, you are paying payroll taxes, which is the same thing as self-employment tax. It's going to Social Security and Medicare. So, um, as an employee receiving a W two, you can defer up to $23,000 into a 401k. As an employer, you can contribute up to, well, there's two different limits. One is that you can contribute up to 25% of the W 2 to that employee's retirement plan. So if you pay, so let's just put numbers to it. Let's say you take a W 2 of $100,000. I can take 23 of that as the employee and put that aside to my 401k. And that brings me down to 77 taxable. And then the employer can put in 25,000, which is 25% of the 100. And so the total going into my 401k is 23 plus 25, which is going to be 48. So that's and that 25,000 on the company side is a deduction for the company, so it's going to lower my pass-through income by $25,000 there. Now the other limit is that the total amount going into my 401k on my behalf, total amongst all 401ks, is 69,000 for the year. So if I can put in 23 as an employee, then I can put in 46 as an employer, and then I need a salary that's 4 times the 46 in order to maximize that benefit. So that's actually, because there's that split between employee and employer, is the reason why 401ks are more efficient than other retirement plans. Because you can do a SEP, but a SEP is going to be an employer contribution, but it's only the 25%, same total limit of 69. But then in order to max out that 69, you would need 4 times 69 of wages and not 4 times 46. So that creates a higher wage, that creates higher payroll taxes, and that is a less optimal outcome. It also reduces your qualified business income for 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 qualified business income deduction purposes. So because you get that split and you can offload it part of employee, part of employer, that's why 401ks are more efficient. Now there is another type of retirement plan where you can put in more, and you can put in up about a quarter billion, um, which is a QRP, Qualified Retirement Program, or it's a plan, one of the two. However, the difficulty there is that you have to have an actuarial calculation, and then you have to commit to funding it for several years, 7 years, I believe. So uh, the sometimes you'll see these on TikTok or whatever. I blame TikTok for everything, but the uh, so those larger dollar limits do exist, but you've got to be able to put that amount in for like 7 years plus, and then you have to have payroll to justify that over that period of time. So unless you're a very high income earner, then it's generally not feasible. So the 69,000 to the 401k is kind of your standard plan that we'll recommend. Um, and then, as just as an aside, another way to fund retirement plan, not for you but for your kids, is through the Climbers retirement plan, where you put the kids on payroll. There's all kinds of caveats with how to do that, but once your kids have earned income through payroll, then they can contribute to their own IRAs at $7,000 a year. So if you do that from ages 8 to 18, and they never touch the money, which is a big element there, then if future is like the past in terms of investment gains and stuff, they'll be millionaires by the time they retire, even after inflation, which is an important caveat there. So yeah, that's the usual way to do retirement. It does require paying into Social Security and Medicare. That's the core element. Is that if you don't pay in taxes on Social Security and Medicare, then you cannot contribute to retirement. And that's true for pretty much all the plans. I think it's all of them. I'd have to double check me if it's every single one of them, but I think it is all retirement plans require Social Security and Medicare taxes either in the form of self-employment tax or payroll tax.
Alrighty. So speaking of S Corp again, Neil,
Yep.
have another question here about distributions and contributions. Can you
Uh-huh.
explain the difference?
Yeah. So contribution is the owner putting money into the company. Distribution is the owner taking money out of the company. So neither one is a taxable event, but they do affect your basis. So what happens there is that if you're running a cash business, then you can never get into trouble with basis because either the money's there or it isn't. Where people get into issues with basis, which is how much net investment do you have into your company, is with loans. So if the business gets a loan and then you withdraw money from that company, and because that loan creates cash there that you didn't earn, right? There's no associated income with it. So if you withdraw through distributions money from a company greater than the extent of investment you have into the company, then that's what's called an excess basis distribution. And effectively, what that does is it creates a capital gain event. Um, so it's like you're selling the company before you sell it when you do that. So that's the thing to keep in mind and be careful of. And then the other thing is that if you have a loss for any particular year, the corporate loss is only deductible up to the amount of basis that you have. So again, loans make this tricky. So let's say you you have $50,000 invested in your company, and uh, you know things go bad. The maximum to be lost is $50,000 because that cash came from your bank account, went into the company bank account. Other cash came into the bank account from sales or whatever, and other expenses went out of the company bank account. But the maximum there that could be spent is whatever came in from sales plus the 50,000 you put in, right? So in that sense, it makes sense. But if there's loans involved, if there's credit cards or more structured loans or whatever, then that increases the cash available to spend. But the limit, as far as you taking up a deduction on your taxes, is still the amount of money that you put in. So sometimes people get tripped up by that because they don't understand. It's like, well, I lost $100,000. Why can't I take $100,000 deduction? Well, you did lose $100,000, but 80 of it was loans, 20 of it was yours. So you only get the 20, and the 80 will just roll forward, until you correct that balance or what have you. So that's the thing to keep in mind as far as contributions and distributions, because it affects your basis. And then if you ever sell the company, then your basis comes into play there as well. So those are the things that matter. Um,
Oh,
just as a general thing, you should be aware of how much net you have in the company. And as you become, businesses go through, a life cycle. Typically you're going to be funding it at first because you got to get stuff up and running, and you're not 100% sure if whatever business idea you have is going to work, and then you're spending money. So losses at the beginning is very normal. Very few people hit it out of the park immediately. Every once in a while, but it's rare. And so you have to keep in mind how much you're putting into this. And then as the company, if the company becomes successful, a lot of companies fail, but if the company becomes successful, you want to over time, be pulling out your initial investment, and then you're going to have, just kind of a regular ongoing operation. But you don't want to, unless there's a business purpose to it, like an acquisition or something. You don't want to just put money into a business and then just leave it there. The goal is for that money to do something, whether it's to grow the business or acquire another business or whatever, acquire assets. Um, but money just sitting there is not helpful. So that's where the contributions come in. And then the reverse of that is when things work out, you take the distributions to even out. That's kind of the basic idea.
okay. So now, Neil, we're gonna go over to the tax relief questions, right?
Yes.
So we have a question from a client that asks, how can a taxpayer find assistance if they can't afford to pay their tax bills?
For their tax bill. So, if they owe taxes from a previous year, or that kind of thing.
Yep. Hmm.
Okay. Well, so there are a couple different things. So one is that um, if you can't afford help at all, there is the VITA, the Volunteer Income Tax. I forget what the A stands for, but it's where people volunteer to help people with the IRS. Their their tax advice is hit and miss, let's say, because you're dealing with volunteers. But so that is one place you can go to for assistance. I think the A might stand for assistance. Um, but so the VITA office is one resource. If you have a debt and it's in such a way that you cannot pay it because you don't make enough. So let's say you had some big event in a prior year that created a big tax burden, and then life happened. You don't make that anymore. That money's gone. Then you can do two different things. So one is where you can do an offer in compromise. And with the offer in compromise, well, the process for these two things is the same. There's offer in compromise and currently non-collectible status. So in both of those, basically what you're doing is you're asking the IRS to give you leniency because you don't make enough money. And there's forms to fill out where you have to list all your assets, all your bank accounts and credit cards and cars and any stock brokerages that you might have, any life insurance that has cash value. And so you list all your assets, and they give you a buffer, a small buffer, but a buffer, all your real estate if you own a house, um, and they'll give you a buffer to keep, and then basically they're saying, okay, if you sold all the rest of it, and your income is whatever it is, minus current general expenses for a household of your size, if that amount can't pay us back in a short enough time, then we will reduce the amount owed to the amount that you can pay if you liquidated all that stuff. And basically, there's a 5 month test and a 24-month test. So you submit this application with with a request or with the offer in compromise. That's the name of the form because you're offering the IRS less as a compromise between zero, which is what you're paying now, and what you owe. As hopefully you meet in the middle somewhere. And so you do that, and you submit a payment, along with that as kind of like a show of good faith, and so that you're coughing up something, and then the IRS will consider it, and it takes them whatever 6 months to consider it, and then they will say yes or no. Most of the time, they say no, and the reason they say no is because when you factor out all those numbers, it's like, well, according to the IRS calculations, you can't afford this. Um, so if but if your you know asset liquidations plus monthly income is low enough such that you can't pay it back in a timely fashion, then they will accept your offer and compromise, and they'll need all kinds of proof, and you go back and forth, and it's a whole thing. Um, but it does happen. And then currently non-collectible is a more extreme version of that, where you do all that. And it's like there's no way I could pay anything, so my numbers are negative after we do this analysis, so I can't pay anything. And then they just put you in a separate pile for 10 years, and they say, okay, you can't pay any taxes. And obviously, all that will change year to year as more information becomes available. If you suddenly get a new job or a new business or whatever, and things work out, then you'll have to pay on the old debt. But if your income drops and it stays low, then you can either reduce the amount or pay nothing towards it. The most common thing to do, though, is that they put you on a 6-year payment plan, so 72 months. And the thing about payment plans is that there's interest occurring depending on what the current interest rates are. Right now it's 8%, which is not the worst thing in the world, but it's not great. It used to be like super low, which is great. but but right now it's 8%. So the payment plans are basically like if you got a mortgage for that amount, it's going to amortize and it's going to go to zero at that, but you're going to be paying interest along the way. So they do. The great thing about payment plans is that they stop the phone calls, they stop the harassment, and as long as you make your payments, you won't hear from the IRS at all. As long it's like the mafia. As long as they get their money, they're perfectly nice to you. So, but it does not save you from interest. So that's just the the usual path. And if your total tax debt is under 50,000 and you're able to afford a payment plan, you can just go online with irs.gov and set it up, and it's automatic. If it's over 50,000, then it's got to be a manual approval, unless you're doing under 100 in under 6 months, and then it's automatic again. But very few people do that. So, um, so yeah, that's what most people end up doing. So the better thing to do than all of that is to actually fix the problem.
Right.
so
I was going to say that too.
so so the offer and compromise and all that is the last ditch effort, basically. And what you want to do is figure out. So many times when people come in with old tax debts, it's because things were done wrong. Because for the most part, there are exceptions to this, but for the most part, if you if you made a certain amount of money, you're able to pay the tax, more or less. Maybe you're short a little bit, but it's not going to be like, I have nothing and I owe $50,000. That doesn't happen unless something was done wrong. Now, I won't say never, but usually it's because there's an error. And I've seen all kinds of errors. I've seen like the biggest one that gets people is I think we talked about this in our prior live stream, where a guy had some real estate, and everything foreclosed, and he got hit with forgiveness of debt income. So when you borrow money, it's not income because you have to pay it back. But then if you don't pay it back, it does become income at that point. So so he had all this forgiveness of debt income from mortgages that went bad from the Great Financial Crisis, and there was also an associated loss of a property, which had an offsetting loss, or capital loss against that, or in his case, it was an ordinary loss. That was the whole thing. Uh, so if you took the income without taking the loss on the property, then you end up with a huge taxable event, and you're stuck because you have no money, you have no property with which to sell and then pay the tax. So that's the kind of stuff that gets people into trouble. Um, the other thing that gets people in trouble is if well, two other things. One is innocent and one is not. So uh, the one that is innocent is just poor planning. Is I've seen it happen many times where somebody will be doing really well in investments like stock trading or options trading or something, and they have all these gains throughout the whole year, and then they keep rolling it forward, keep reinvesting, and then from December to January things go bad, and it's like, well, I made all this money, I have all these this taxable gains from the whole year, but then I lost all that same money in the trade, but that went on next year's tax return. And the way capital gains works is you can't take the one the year after against the year before. So you're stuck with the bill for the ones that you made, even though you lost it afterwards. So that could be a problem, which is, I would say, it's poor planning, but it's not nefarious, right? and then the one that is nefarious is deliberately doing something with the money to try to get out of having it in. Trying to think of a simple example because it's uh, I'll tell you one thing where the IRS gets really bad is if you have people on payroll, and so you have these trust accounts for Social Security, Medicare, for payroll taxes. If you don't pay them those payroll payments, they will come after you very hard. So I've seen a couple of cases, and I tell people all the time: do not do this. Uh, do not play around with the trust accounts because they will come after you, criminally for that rather than civilly like everything else. So yeah, don't play around with that. I've had people say to me, it's like, well, I needed the money for this. I was like, no, you don't. You didn't need the money for that because that money is set aside on behalf of the taxpayer that you're paying, the employee, and so that's not your money to play with. And people do all kinds of silly things, but fortunately, that is relatively rare. Most people just pay the payroll taxes as they occur. And if you're using a payroll processor like ADP or Gusto or whatever, they will take that money out of your account, so you can't even have the opportunity to play around with it, even though it's not submitted until every 3 months. So that is a place where it can get very nasty with the IRS. All right. That does bring us to the top of the end of the hour, and let's talk a little bit about next steps. So we do have a workshop coming up on Thursday, which is August 8th. Today's August 6th, and you go to taxsherpa.com/summit-workshop, and that is going to be a workshop on our summit strategy sessions and how to go through that whole thing. I actually spent all morning working on notes for the workshop, and it's it's one of my favorite strategies, to be honest. And it's one of my favorite strategies because it does a couple things simultaneously. So one is you get a great tax deduction. Very often we can find 15, 20, $25,000 worth of tax deductions that you still get to keep the money for. That's that's the whole thing. And the other part is that so many small business people, which is our tribe, so many small business people um, end up so caught up in the day to day that they lose sight of the bigger picture. So there's kind of uh, on a strategic level, there's sort of three steps. So there's tactics, which is okay. We're going to do this thing in order to achieve this result, right? There's strategy, which is what are the goals that we're going after? What tactics do we want to employ to achieve what ends? That higher level of thinking. And then there's the ownership level, which is above strategy. It's how do we assess the business as a whole? And most people are stuck at the tactical level because they're just doing their thing every day. It's like I gotta wake up, I gotta go to my email, I gotta check who made orders or who needs support or whatever. I gotta fulfill those. I gotta do marketing to get new clients or customers, and I gotta do sales calls, or I gotta tweak my website, or I gotta do increase my ad spend, or I gotta chase after this guy who owes me money and hasn't paid me, and all these things that have to be done as owning a business, whether it's just you or whether you have a team. People get caught up in that. So the great thing about the Summit Strategy session is that it gives you a structured way to step outside of that once a month and assess your business as a whole and say, okay, We take a deep breath, see where we are, see where the money's at, see how the last month, how the last quarter, how the year's going, see how that compares to what happened before. And then it'll have you work through what I call the small business equation, which there are 6 numbers to track in your business that if you follow the equation, then you will be playing the infinite game. You will have enough money to keep playing next month. And so it'll take you through that analysis. And then, oh, and by the way, I've created custom AI stuff to have you work through all this. So it's actually easier and faster than it ever has been before because the AI is getting more and more powerful. I even created another AI to do very basic bookkeeping for you, where you can just take a bank statement and then create a P&L out of it. Um, which is, you know, it's iffy to be honest. But if you're not making enough money to have a bookkeeper, then it's something basically. And it only works on one account at a time, and so it's fairly limited, but it does do the basic job reasonably well. Uh, so it takes you through this whole analysis of getting the lay of the land, surveying where your business is, uh, how things have been going, and then gets you to focus on, okay, what is working, what is not working. And if you just do this once a month and you figure out what is working, do more of that, figure out what's not working, do less of that, and you do that over and over again, the things start to split. So you do more and more and more of what's working, you do less and less and less of what's not working. And you look back a year, 2, 3 in the future, and you're light years away from where you started because you're paying attention. And
Mhm.
99% of the small business people out there, your competition, are not doing this because they're caught up in the day to day.
Mhm.
So come on out to our workshop. I'll show you how to do the whole thing. And the workshop's going to be an hour. And I figure I'll probably have another hour worth of questions. That's usually how it goes. So I actually blocked out 2 hours for myself. Uh, but we'll answer all the questions that people have on there. So taxsherpa.com/summit-workshop, and hopefully we'll see you there on Thursday. But otherwise, on Tuesday nights we have these. Taxsherpa.com/live. We'll take you to the next one. In fact, while we're here, I had the update ready as far as the URL for the next week. I click update, redirect, and redirect updated. So now, if you go to that link, it'll take you to next week's YouTube page for the stream. But other than that, that's all I got. So, Serena, any final words to leave the audience with?
Yes. Invest in a tax plan and stay proactive, and we'll see you at the workshop.
I like it. All right.